Okay, 6 o'clock it is in Perth, 8 o'clock in Eastern States. Good evening to you. My name is Garth Davis. Wanted to welcome you to this educational webinar this evening. Titles on the screen there, tips and strategies to save tax with property in this financial year. So very good evening to you. Very important topic this time of year. I've got two excellent presenters for you this evening in the form of Gillian Nathan. Good evening to you, Gillian.
Hi Garth, how are you going?
Good, thank you. Sound check's great. And Alan Kinder from BMT, good evening to you, mate.
Hey Garth, how are you going?
Great, thanks very much. Okay, so great to have you guys on board. We've got 30 minutes. I'm going to get the show on the road. So just to give you a bit of background on myself, so my name is Garth Davis and I'm going to be your host this evening. I am the founder and CEO of Property Powerhouse. I'm very passionate about property, very passionate about helping my clients achieve their property goals and their wealth goals, and explain to you a little bit in the next couple of slides how we do that. Just before we get tonight's proceedings on their way, I'll see if I can get the next slide up for you. And just a disclaimer for tonight that the information is general in nature. It's not specific to any one person's special requirements or circumstances. So just general in nature. Please consult your accountants and financial advisors directly for your personal circumstances. Thank you. So Property Powerhouse, sorry, beg your pardon, just trying to move some of and if you've got our little pictures up on the right hand side with the presenters, you can move to one of the little boxes at the top there, or minimize if you'd like, if that's in the way at all for you. So Property Powerhouse, what are we? We are the experts in investment property. And as you can see on the screen there, our mission statement is by providing education, support and experience, Property Powerhouse enables mum and dad investors to buy properties all around Australia, building up their wealth and enabling them to retire debt-free on their own home and create multiple passive rental income streams. Something we're very passionate about. An example for you. So what makes us different at Property Powerhouse? Well, this was a wonderful example. This was a property that actually settled recently, just before the travel restrictions. And this was an example of our clients, Cecilia and JP, who were actually on this evening. They're on the webinar. The example here is just to show you how well our systems and our team works across, and our preferred partners that we work with all around the country. So our clients, investor clients, were based in Melbourne. The property consultant lives in Perth. The finance broker is in Adelaide. The property is in Brisbane, and our property tour guide, who's Christina there on the right, also listening in tonight, and property consultant with us. She lived on the Gold Coast. So it was just, for myself as the owner of the business, I was just so proud of how an example like this played out. We had really happy clients. The builder developers were very happy. As you can see underneath, the property settled within 2 days of settling. It had a tenant. It settled on the Monday. We had a tenant by the Wednesday. The property valued on the money. The clients had gone interstate. Part of our special things we do with Property Powerhouse, we reimburse the travel, some of the travel expenses if someone buys interstate. We also refunded $200 against the building inspection. So those are all the good things that we do, and we trying to pick and research the best markets around the country. And that was just a wonderful example, and just what wonderful clients, JP and Cecilia, just wonderful clients, and just a very good success story to explain very simply how we work and where we work. All right, that takes us to our first presenter this evening, our first main presenter. I'd like to introduce to you Gillian Nathan, the tax accountant with Simple Accounting Solutions. Just a little bit of information on Gillian. So she is a qualified chartered accountant with article experience in a Big Four firm. As well as completing her master's in taxation and international taxation, she is a registered tax agent and has maintained her tax practitioner status in South Africa, allowing her to lodge returns and provide taxation advice in both South Africa and Australia. Gillian's experience includes sitting on board of directors at listed clients, being a member of the junior executive board at South African Revenue Services, and facilitating international discussions in the negotiations of double taxation agreements. Gillian is currently a board member on the CAANZ, not-for-profit financial toolbox, and volunteers extensively on PNC and sports club committees. Gillian has combined her passion for education, taxation, business, and accounting to build simple solutions accounting services. We're not providing real-time financial services to small businesses and individuals. Gillian is catching up with her hubby when she gets time and chasing after her 2 sports crazy kids, or attempting to hide behind her Kindle and a glass of SB, or at least a hot chai latte. Good evening to you, Gillian. Take it on.
Hi. Thanks very much for that introduction and for having me this evening. So I will kick off. I'll try and keep it short and sweet and simple and to the point. Some of what I'm going to say to you this evening is definitely nothing new, and I'm pretty sure that your astute property investors would know a lot of this information, but it's just to reiterate some of the basics. So just to remember, if you're trying to claim deductions for rental property from a tax perspective, that property actually has to be available for rent, and the percentage or the deduction that you're going to claim is related to your ownership percentage. So you can have what you hear quite often as a joint tenant, where you'd be claiming 50% of their property, or otherwise a tenant in common, and that wouldn't necessarily be an equal share, rather an unequal share. The other thing that we just need to keep in mind and remember is if you're charging somebody a rent that is not market related rates, so you're not going to get away with mates rates here, because they will limit the deductions to the rental income that you actually receive. So you actually need to be charging an arm's length or a commercial rental rate in order to be able to claim a deduction, in order to be able to claim a loss. Otherwise, as I said, they limit that deduction to the rental that you've actually received. So some of the more typical deductions, and I'm not going to go into great detail for all of them, but you basically can get an immediate deduction for any of your expenses which relate to the management or the maintenance of their property. So that will include an extensive list, advertising for tenants, some of your council rates, electricity and gas to the extent that it's not reimbursed or paid for by the tenant. If you've got gardening expenses, land taxes, so this would be payable when your investment property exceeds the state land value. Your pest control, a very worthwhile expense is obviously your depreciation report cost, and Alan will tell us a little bit more about the benefits of having one of those. Any ad hoc sort of expenses that you're incurring, some cleaning, legal, lease fees, obviously your property agent fees. That is if you're using a property rental management company or provider to maintain or manage the property rental for you. Your insurances, any security costs, and then obviously your water rates. Can you do the next slide, please, Garth? Thanks. So the previous slide was just about your sort of stock standard basic deductions. The deductions that I've listed on this page here, you need to make sure that you've got paid a little bit more attention to detail for these, and that you've got your ducks in a row when you're wanting to claim these deductions. So your LMI and borrowing costs, generally speaking, you'd be able to claim them over the period of the shorter of the loan, or otherwise 5 years. Your interest expense is something that the ATO is looking at quite closely at the moment. We need to make sure that the purpose of that interest incurred is to produce income producing income, and if there is like a mixed use, or where you've used some of the funds for personal use, you need to apportion that rental deduction. So you just need to make sure that you've got the finance over the investment property correct, so that you can maximize that interest expense and deduction. Your repairs and maintenance is another one that the ATO focuses on. Generally speaking, when you acquire an investment property, anything that's done within the first 12 months is going to be deemed to be part of the acquisition cost or the price. So you're not going to be able to claim repairs and maintenance expense on that. And then we just need to think about improvements versus a repair. So where it's a repair, you can claim it immediately, but when it's an improvement, then we need to capitalize it and depreciate it over a certain period of time. I'm not going to go into extensive detail again on the depreciation because Alan will touch base on that, but there's two types. There's the capital works and the furniture and the fixtures and fittings, and both of them will be deductible. And Alan will touch on the changes that have happened in the legislation since May 2017. And then travel is no longer deductible. It's one of the things that the ATO has done away with unless you're running a property business. So you used to be able to claim the travel flying interstate to check up on your rental property, and unfortunately that's been done away with now. If you can move on, thanks. So if you are settling a property now, look, I know we're close to the 30th of June, but I'm pretty sure Garth's got some amazing properties on his books and he's got some ready to go and ready to be settled. So if you can make it happen before the 30th of June, obviously all the expenses that we've chatted about on the previous slides would be immediately deductible, provided it's available for rent. Obviously, it would only be for a short period of time. It would be from the time that the settlement happens until obviously the 30th of June. So your costs of acquisition generally not deductible. I think ACT has got a random deduction in terms of your leasehold and stamp duty and that, but the rest of the states, it's added to your base cost and deductible to reduce your capital gain. Can you move on? Okay, so one of the questions that I get asked quite often is whether or not your tax savings can only be claimed at the end of the financial year. So what happens, generally speaking, is you'll get a large refund if you've got negative gearing on your property. So what some people do is they apply for what's called a Payg withholding variation, and that allows your employer to vary the amount of Payg withholding tax that's withheld on your weekly, fortnightly, monthly salary. So effectively what you're doing is you're ending up getting the benefit of your refund in your monthly paycheck. So you don't have to wait until the end of the financial year. Obviously from a cash flow perspective, it helps. You know, so it's your choice really, whether or not you want your big lump sum at the end of the financial year, or otherwise, if you want the benefit of that cash flow to help you pay for some of the costs of your investment property throughout the year. So this is a specific form. You need to apply and lodge at the ATO, or otherwise you can get your tax accountant, tax agent to assist you with that. And just a sort of word of caution or a word to note is that just because they've granted that Payg withholding variation doesn't necessarily mean that they've actually accepted the tax treatment. You obviously still need to complete your return, and you still need to have all of the supporting documentations, and obviously be subject to an audit should the ATO decide to audit you. So it's not a guarantee that they've accepted those deductions, but it does definitely allow you to sort of manage your cash flow on a more regular basis rather than waiting for the end of the financial year. And it's not only applicable to your rental losses, it could also be if you've got business losses or other investment losses as well. So just a very, very high level example just to explain what I'm saying. So Jason's a project manager, he's paid a normal or a usual wage, and that amounts to $80,000 a year. And he obviously, you know, his Payg withholding would normally be calculated on that. But he also owns a rental property, and he's got a loss effectively of $10,000 each year. So his estimated taxable income would be $70,000. So he can apply then to have his variation to only have his Payg withholding based on $70,000 instead of $80,000. Can you move on? So I touched on this briefly about the travel expenses. It was one of the questions that we got that came through before the webinar. So no, unfortunately not. Unless you've got a property business, you can't claim your interstate investment property travel anymore. I'm just going to touch really briefly on self-managed super funds because it's another question that we get. So just a sort of caveat or a disclaimer is that I'm not a financial planner and I'm not allowed to be giving you sort of financial planning advice. But just in terms of your residential property, in terms of your self-managed super fund, if you have one, obviously property is a popular choice in terms of a self-managed super fund. What you can't do in terms of a residential property is if you own if you have an existing residential property, you can't transfer that into your self-managed super fund, either at the market value or otherwise by contributing it within the cap limits and that. It has to be a completely unrelated property. You also cannot live in that residential property if it's owned by your self-managed super fund. So you can't do something like have a holiday home and live in that for a portion of the year and have that holiday home owned within your self-managed super fund. But obviously, if you're going to use a self-managed super fund to build up investment properties, definitely a good place to have it when they're unrelated residential properties. And then just with regards to commercial property, again, in the self-managed super fund, this is different to the residential property because you can actually have a related person renting that commercial property. So quite a popular structure is where you've got a business owner, small to medium business owner, who is renting his commercial premises, and he decides that he'd rather own that commercial property. Quite often what they do is they'll set up a self-managed super fund, which will then acquire the commercial property, and the business then leases that commercial property from the self-managed super fund. So obviously you need to make sure that it's all done at arm's length, and just be aware that when you're transferring property across, you could have something like stamp duty, tax implications, capital gains tax, etc. I think that's maybe me. And that's, yeah, thank you. Short and sweet, I hope. If there's any questions, feel free to pop them into the chat box and we'll see what we can do.
Yeah, thanks, Gillian. That's great. And there will be questions at the end. So some people did send their questions in early, but there's a chat box there. If you keep it relatively short, we'll see if we can get the experts to answer them here for you. So, Gillian, that was a bit sad to hear that we can't put our holiday home in our self-managed super fund and rent it back to ourselves, but so be it. I will have to come and get some advice from our tax accountant.
Definitely.
All right. Well, thank you, Gillian, and please stay on for some questions at the end. Our expert speaker, and thank you, Gillian. It was really good to get an overview of what's going on, and we know the goalposts are moving all the time with tax, and that's why, guys, as property investors, you've got to have a good team of people around you. You've got to have a good advisor in the form of a tax accountant, a good finance broker, a good property manager. Got to have your depreciation schedules. You've got to be on top of the game, and that's what we try and do at Property Powerhouse, is educate you to make sure we're putting all these good people like Gillian and Alan around you. So that leads us into our next expert speaker this evening. That is Alan Kinder, the Business Development Officer for BMT Tax Depreciation. Very well known tax depreciation quantity surveyor business all around Australia, have a very strong brand, and particularly people in investments know of them. Since joining the BMT team, Alan has played a key role in educating investors and property-related organisations about the importance of property tax and depreciation. Alan has become actively involved in new business development and is well versed in explaining the differences depreciation makes to the post-tax of owning an investment property. Alan believes that depreciation plays an integral role in helping people get the most out of the investment property and assist people to be able to acquire more property and build wealth through property investments sooner. And that's very much the case. So good evening to you, Alan, and I'll just move the next slide. Sorry, just before I do, those are some of the details for Gillian there, the name of her business. So have a look for her up on Facebook, Instagram, and LinkedIn. And kindly, Gillian and Alan have given us permission to share their slides tonight. So at the end of this presentation this evening, I will be sending a PDF and you'll be able to get that information. So thank you. Good evening, Alan, and over to you.
Thanks, Garth. So yeah, you've already given me a a stellar introduction, so we can probably skip this first slide that's got my name on it. So I'll just quickly touch on who BMT are. BMT are a quantity surveying firm, so we're not accountants. We are registered tax agents because we provide a report that's relied upon for tax purposes, but we don't actually give accounting advice or do tax returns or anything of that nature. So definitely talk to Gillian if you've got tax questions later on. But basically, a quantity surveyor typically works in the construction industry. So if someone was wanting to build a 30-level unit tower, the bank typically won't trust the builder. They won't just give them $30 million and trust them to manage those funds for the life of the project. So the bank will ask the builder to go to a quantity surveyor and get them to cost out the job and say what all the materials are worth and what all the fixtures and fittings are worth and how much labor is involved and everything of that nature. So what BMT do is specialize in the post-construction phase. So we can probably go to the next slide, Garth. So post-construction, we're talking about property depreciation. So a lot of the time you might just have a purchase price. And unfortunately, you can't go to Gillian with a purchase price for the property and say, can you claim some depreciation for me? You need a quantity surveyor to isolate what the land's worth and park that to the side because you can't claim on that. And then work out what the structural elements of the building are worth and what all the fixtures and fittings are worth, and itemize all that so that the accountant can actually use it in your tax return every year. So more or less, the ATO allows you to claim wear and tear on the investment property as a tax deduction. That's what property depreciation is. So just looking at the slide here, we can see a bunch of numbers. So these are just average deductions that we would find for our client typically, depending on what type of property they come to us with. So we've done a bit over 650,000 depreciation schedules in the last 23 years. So we've got some pretty good data to work with there. So if you were buying a brand new unit, your first full financial year of claim, you're probably going to get close to $14,000 as a deduction. Total depreciation might be $315,000. An older property that's been renovated, you might see around $5,000 in the first full year and potentially about $40,000 over the life of the property. So that's probably allowing for a bathroom update, a kitchen update, some fixtures and fittings and things of that nature. Commercial warehouses, offices, things of that nature, a little bit different. They can range anywhere from something similar to a brand new house to literally hundreds of thousands of dollars in the first year. So it just depends what you're actually looking at. Just to, I guess, circle back, because Gillian said that I'd probably talk about this. So you probably see that there's quite a difference there between the new property versus the second hand. So the government did change some legislation back in 2017 about depreciation. So some of you may have heard about that. Some people are very confused by it. I've had people say to me, oh, is depreciation illegal now? So it's not the case. That they basically just limited what you can claim on a property if it's secondhand. So with the new unit, you're going to be looking at all the fixtures and fittings, the carpet and blinds and smoke alarm, and then all the common area assets as well. Even things like the lift, you can claim a percentage of all those types of things. With a secondhand property, you can only claim really on the structural elements of the original building and then any things that you've added to the property yourself. So if it's a total knockdown rebuild, then you might get a claim similar to the newer one. So frequently asked question we get, does my accountant look after this? Pretty much have it every day. Even when the accountant says, get in touch with BMT, I don't know why they're telling me to contact you. Unfortunately, the ATO doesn't allow the accountant to estimate construction costs. So certainly if you go to the accountant with a receipt for a dishwasher, they've got the cost and they can do something with that. When there's just a purchase price for a whole house, you need a quantity survey to break it up so they can use it. And is the property too old? Never too old to ask the question. We'd rather you call us, doesn't cost you anything to inquire and say, how much can I get? It could cost you a lot if you just assume that it's not worthwhile and you don't ask the question. Probably right for the next one, Garth. So finally, telling you about all these deductions and people want to know how much it costs. Well, Garth's actually negotiated a reduced fee for his clients nationally, $7.15 including GST. It's a one-off fee. Gillian mentioned in hers that the fee's even a tax deduction for you before I believe it's considered an expense relating to managing your tax affairs. So you can claim that, and yeah, a one-off thing in that respect as well. The report will map out everything until there's nothing left to claim.
Brilliant. Thank you so much, Alan. And yes, it's a privilege to work with BMT Tax Depreciation and also with Gillian. And those tax depreciations schedules are so important for investors. As you've heard, it's a one-off cost. You never need to do it again, and it is a tax deduction. And we come across so many novice investors. We find them after they've bought a property and have got problems and they're having problems with cash flow, and we reach out to them and say, well, you know, did you get a depreciation schedule done? And they look at us like we're speaking a foreign language. They say, well, what is that? And you kind of work backwards that they haven't got it. And Alan, I think we can even go back, you know, even if it's, you know, as you said, if it's, you know, from 3 years ago when the purchase was done, we might be able to get the depreciation schedule done, and they go to the accountant and see what can be done about maybe claiming some of the stuff they've missed out on. Now, we do have some questions that come through, so we're tracking really well. We've got about 4 to 5 minutes. So here's a couple of questions. One that has come through. I'll go to Gillian first, and then there's one for Alan. So Gillian, well, this question came through. What, in your opinion, is the ATO going to target regarding investment properties this year? Are there some certain areas that they're going to be flagging?
Yes, Garth. So, I mean, just like a random fact is that the ATO said something, 2018, I think there were like 2.2 million taxpayers out, and they claimed $47 billion worth of deductions. So property is always going to be a hot spot for the ATO, and things that they're going to look at, I did touch on briefly during the presentation, but it would be, you know, your repairs, so improvements versus maintenance, obviously the deductibility of interest, whether or not it is used for personal funds, or if it's actually been, the purpose of it is to for the income producing asset. Obviously, they're also going to look at things like holiday homes that are being claimed as rental properties. So has that holiday home actually been available for rent, or are you just trying to sort of pull the wool over the ATO's eyes and it's actually just your holiday home, and you maybe like let it out for 2 weeks of the year to somebody that you know to try and get all the deductions? And then another area that they do always look at is the new rules for the decline in value. So that's just what Alan's chatted about now, the change in legislation for the second-hand assets. So that's always good to have a depreciation report just to cover your backside when you're trying to claim those deductions.
Excellent. Question for Alan. So if you just want to unmute yourself, Alan. This came through. What is the average deduction you find for your clients?
So it varies a little bit. If it was a brand new house, I'd say around $9,000. If it was secondhand, I'd say close to $5,000. For a new unit, it might be around $14,000. A secondhand unit, anywhere from $4,000 to $7,000, depending on how many levels the building is and if it's got pools and gyms and so on. With commercials, the commercial properties, the Humble Warehouse is about $8,000 on average. And as much as I've worked on this hemisphere's largest solar farm, and their first year deduction was $15 million. So Not sure if anyone watching has a solar farm.
And to think what the cost,
Yeah.
if the depreciation's 15
Bit more than the 715. It took me about 3 days to inspect the site, but
No, that's interesting. Thank you. There's one more live question that's come through, and I'm going to go to Gillian. She has answered it internally, but I think it's a great question. So let's ask it. This came through from Nathan, who's on this evening. How does the ongoing depreciation deduction affect when a property is sold, especially if a property happens to be sold at a loss? So sometimes this can happen when the property's only been bought for 3 or 4 years, and whatever reason someone has to sell. Can you explain with an example?
Yeah, sure. So, I mean, I did reply just to say that, yeah, so the depreciation that you've claimed is definitely added back from, or added back to the base cost when you sell. So obviously, if you've got a loss, the loss is going to be reduced. And I just said that if Nathan's happy for me to get his email address from you, I will send a detailed example to him, or otherwise if he's got a specific sort of set of circumstances or facts that he'd like me to do a very high level estimated calculation for him, I'm very happy to help him with that as well.
Okay, no, well, that's excellent. We're going to be very prudent and finish on time-ish. We're 1 minute over, but what we wanted to do tonight, as usual, is give good educational content. There's been no selling here tonight, just good, honest information for you. We'll continue to deliver good property education information to you, our clients, and this is a nice free webinar for people to come on. We will be emailing out tonight the slides from these excellent presenters this evening, Alan and Gillian, and I will also be providing an email address and a landline number. So if you wanted to reach out to Alan or Gillian, you do have access. Access to them. We will be inviting them also to our face-to-face events. So for people in Perth, when we have our education events in Leederville or our social events also in Leederville, you will see Gillian and Alan there. Gillian will be also coming to Brisbane and the Gold Coast with us once we can start traveling, and hope to see Alan or one of his great representatives there from BMT at our events also. So in closing, just wanted to say thank you very much. It's a pleasure from the team here at Property Powerhouse, which includes Gareth, also Christina and Murray. We look forward to helping you, and we'll be reaching out the next couple of days to do a follow-up. So do expect a call from our team just to see how you've enjoyed the night. Give us some feedback about information you'd like to know in upcoming educational webinars. Very good night. Thank you again to our presenters, Alan and Gillian. Have a good evening from Property Powerhouse. Thank you.
See you guys. Bye.
bye.